Big question, though, for the markets and for the global economy is what will the Federal Reserve do next? State Street's John Herrmann said that Fed minutes show policymakers were already troubled by the unemployment picture, and then this morning's jobless figures, they're not really offering much reassurance. John is a Bloomberg best. He's one of the most accurate forecasters on the economy. He joins us from Boston this morning. John, welcome back to In Business. You had low expectations on the jobs front, but not this low.
Yes. Not this low, but I think very much in spirit and in line with the outcome, and also with our guidance over the last few months. So what we've been thinking is that the unemployment rate, the job picture would deteriorate, and the unemployment rate would edge higher and move higher over the second half of the year. Had that view for a few months now. And what we thought might happen is the Fed might be brought into the game in some shape or fashion. We weren't exactly sure what they would opt to do. They haven't laid out their plan too clearly. But the minutes from the August meeting, I think, were suggestive on a couple of important ways. And here's what I found impressive. They said they were willing to tie the Fed funds rate to condition the outlook of that on the unemployment rate, for example. So I think that would actually, if they said, for example, the unemployment rate, the Fed funds rate would stay low for an extended period so long as the unemployment rate remained above, say, 7.25, that would all give us, from the investment community, give us much more clarity. It would give bank lenders more clarity. It would give business managers clarity because they could base their longer-term decisions on that. So, and it would also help in terms of, I think in terms of just global risk and so on. So that would be an important thing.
We already know the Fed has already said they're going to keep rates low through at least 2013. So are you saying that you don't expect unemployment to come down to that 7.25% level until when? Well past 2013?
I think we could be into 2014. I think the problem we have in terms of deleveraging on the household side, number one, and also with the long-term unemployed, and then even more troubling is the fact that young people are just opting out of the workforce and not really trying to get in. I think that's very, very troubling. So you put all three of these factors together, and there's tremendous amount of uncertainty in terms of the job outlook.
There is a lot of uncertainty on that front. Also, tremendous amount of uncertainty about what's unraveling in Europe. Just before that jobs number crossed, and then after, we saw the sovereign debt, the cost of insuring against a default, just skyrocket when you look at the swaps market. We're beyond what was a previous record high there. The uncertainty is climbing, not just in the U.S., but around the world. So how does that constrain the Fed's ability to act?
Well, it's going to have to motivate them more because, for example, exports to the Eurozone area and Europe more generally is a strong contributor to U.S. growth. And if those markets continue to be upset and their economies continue to slow, just as we saw in yesterday's ISM, we saw the export index slip. So we could see it's now at 50. It could dip below 50 and drag the overall ISM index lower. So the Fed has to be very sensitive to the risks in the Eurozone, and that may also encourage them to do something a little bit more forceful at this September meeting.
Yeah, you're talking about a growth problem far beyond just the jobs picture. How do you trade around this? You had a previous position on, you said the 2s, 10s flattener. Explain that, and are you sticking by it?
Yes, the answer is yeah. We were discussing this before, a few months, about 7 weeks ago, when we were talking to you about the credit risk of the credit downgrade in the U.S., and we thought there'd be some. And remember, we were discussing it was counterintuitive to think it would be a flight to quality in that environment to Treasuries, but we saw investors move in that direction, and we thought that was the right call because the entire stack. It just seemed to us that the entire credit stack was undergoing, a repricing of risk, and we've seen that since in terms of high yield premium and that kind of thing. So we still believe what that means is for households. What that means is that investors become a little bit more risk averse, and they seek to buy more higher yielding Treasury securities, so they buy the back end of the curve. And what that does is it encourages the leverage community to go out and buy, for example, 10-year, and that just pushes these rates lower. So for mom and pop, that means that our mortgage rates, even though they've come down dramatically, could fall, going forward, and that kind of thing.
All right, John Herrmann, always interesting analysis from you. Thanks for joining us from Boston this morning.
Thank you so much.